Hello, everyone, and good afternoon. Thank you for joining me with Coffee with Coach. So, this is a new series that we started with the Boss Mortgage coaching team because I'm finding that a lot of people have a lot of questions with regard to all this misinformation that the media is stirring up. So we wanted to start this series, which will be daily on weekdays, and it will be more of the morning time, but we wanted to do a test run today to see what you guys felt about this segment. But the point of this segment is to bring forward a lot of truths to what's going on and to make sense and give coaching tips on this current market. So without further ado, if you're catching this now, I would love for you to, in the comments, put where you're from, where you're watching this from. I am in Eastern North Carolina, and I would like to, if you want me to come to your coffee shop, we could do this segment at different places. But anyway, if you're catching this later, please give me a hashtag replay down below. Again, would love some feedback about the segment. So without further ado, let's dig into what is going on currently in this market. So today is October 20th. Right now, stocks are slightly lower and mortgage bonds are slightly higher so far this morning. The Mortgage Bankers Association, or MBA, released their mortgage application data for last week. And it showed that applications to purchase a home were down 5% last week. Well, it makes sense, and let me explain why. This is not a trigger to say, oh my gosh, the world's coming to an end and the housing market's going to crash. Year over year purchases, meaning last year's comparison to this year, it's down 12% against tough comps. But when factoring in the rise of cash buyers, they are down closer to 6% instead of 12. Meaning you've seen an increase in cash buyers of like 23%. So that's why the mortgage applications are down. They don't need a mortgage. Also remember that inventory is also down 13% year over year. So from this time last year, it's down 13%. Prices are also up 20%, and rates are about 21 basis points or a quarter of a point higher than what they were this time last year. So these are all these things to consider when looking at why those mortgage applications are down, okay, and the purchases. So refinances were also down 7% last week and are now 22% lower than they were this time last year. Last year, refinances made up about 63% of total transactions, which is down from 64%. While refinance volume is down, remember that you guys, homeowners, have record levels of equity. So, if you want to look at some debt consolidation, we need to quit looking now just strictly at the interest rate, because a lot of people are like, I want to refinance just to lower my interest rate. Well, now could you look at debt consolidation in terms of, okay, my car, the interest rate is 8%, or let's say 5%. My boat that I just bought is this amount, this percentage or interest rate. Let's go 17% interest. You add all those together, and if you could simply cash in on that equity, because again, we have record levels of equity, and what's the reason from that? It's because the housing appreciation has gone up. So while you owe this amount and you bought it, okay, let's say you bought the house here, you owe this amount, right? Because you've paid some off. Well, now your actual house value has gone up here. So look at how much equity you've gained. That money can now be used to pay off some of your debt with higher interest rates. Just throwing that out there. Feel free to reach out to me if you want me to do just a quick mortgage consultation or coaching session with you. So there will be a 20-year bond auction at 1 p.m. today. So it's taking place right now, which that can impact the bond market. Last week's 10-year and 30-year auctions were strong and helped to push prices higher temporarily. So we will see if the 20-year also has strong participation. I will say we are waiting tomorrow, Coming in right now, tomorrow, existing home sales report, they're saying have gone up 1.2%, but I look forward to receiving that tomorrow to tell you guys more about, as well as jobless claims are up 295,000. So those reports should be in tomorrow. We can talk more about that. Few more things. The Atlanta Fed's Q3 GDP estimate has been revised lower to 0.5%, down from 9% not too longer, and 6% just 2 months ago. So, I mean, that's not bad. The economy is definitely slowing a bit as that stimulus wears off. Mortgage bonds right now are trading sideways, and they're in a range between support at 102.313 and overhead resistance at 102. We'll take a look at that. Matter of fact, I will have my friend explain the numbers a little bit better. So I will say, if you are in the middle of purchasing something, we recommend carefully floating, not locking in that rate right at this moment. So without further ado, I'm going to hand the screen over to my friend. Give me 1 second, and we'll let him tell us a little bit more about what's going on with mortgage-backed securities and the Treasury. All right.
And then let's go ahead and take a look at the charts for now. And we are at some important levels. Once we do, you can see bonds are up 8 basis points. And the technical picture, you can see we've been in a clear downtrend as far as mortgage-backed security prices moving lower. Remember, there's always an inverse relationship. When you see mortgage-backed security prices moving lower, that means that rates are moving higher. But it does seem like we've tried to find a bottom here at this floor of support at 102.313, which is the low from this candle on October 13th. You can see we touched on this level. We were able to rebound higher. Part of this move higher was due to the 10 and 30-year bond auctions that were strong last week. But you can see that we ended up ultimately selling off after that. And here we are in this range, again, testing this floor of support, but it has held. And we've been trading sideways here the last 2 days. And let me just refresh this just to make sure I have the most accurate numbers here. Here you can see the last really 3 days that we've really been trading a little bit sideways in this range. So, of course, the nearby support we have is that same level at 102.313. But we do have a ceiling of resistance not too far away at 102.56, which is about 9 basis points above present levels. So we do have some room to the upside, especially if we can get a strong 20-year bond auction at 1 p.m. Eastern time. And if we do continue to see movement higher in mortgage bond prices, we do have the stochastics, which do show that from a momentum standpoint, mortgage-backed securities are in oversold territory. So remember, when you're below this red line of 20, they're oversold. And what you're looking for is a positive crossover. You're looking for this black line to cross over the red line, and that can signal to you that you could see some follow through to the upside. So it's going to be important to see where we close today. If mortgage-backed security prices give back their gains, you probably won't get that crossover. But if they have a strong finish, a strong 20-year auction, then you could see that crossover happen, and you could see some follow through to the upside. When we take a look at the 10-year, we're trading at 162. It's important to note that we've gotten back beneath this 1.628 ceiling. We did break above it. This morning we opened above it. We've gotten back beneath it. So this is an important ceiling to monitor, because if we are not able to remain beneath this ceiling, well, we've had to go back a little bit longer in time. But you can see that the next ceiling is all the way really from the highs from like May, where it's right around 169 or so, 169.8. So the highs from like May 13th of 2021. So getting up there to some higher yields that we haven't seen in quite some time if we can't remain beneath this level. So the advice is going to be to begin the day here carefully floating, see if we get a strong 20-year bond auction. And of course, if anything happens or anything changes, we'll get back to you.